Got a four-person panel today on the commodity report. So Kevin Green is here. We got Sam. We got Kashapa as well. Today we have a bunch to talk about. There's oil is making the big move. Kevin kept talking about the geopolitical risk that was out there. No matter what we're looking at, we are looking at the possibility of this spike higher. We finally got that spike higher. Kevin, what are you seeing in the oil markets? Let's start there.
It's about time for the geopolitical premium to be built in. It's an unfortunate situation, so let's all say that. But at the end of the day, we are traders, right? So getting commentary from U.S. officials that Iran is going to retaliate, potentially 3 to 4 targets within the Tel Aviv area. Knowing that we kind of have this already on the radar, we did see a spike up around 3%. Premiums are fairly cheap when you're looking at the options. But we also have to just be mindful that we've had this type of scenario before. And if it's more of a symbolic gesture rather than something that's going to be just truly impactful when it comes to logistics or when it comes to operations for the Israeli military, let's say for now, we have to just kind of keep our eye out on it. The risk here is nothing when it comes to Lebanon. And any type of infrastructure there or Israel. It's around the retaliatory strikes on Iranian oil infrastructure and logistics, and or if they would like to try to shut, I wouldn't even say shut down, but slow traffic within the Strait of Hormuz. I don't think that they can fully shut it down, in my opinion, but that's the risk there. If you're having a geopolitical trade right now, and guys, I do want to be mindful too. I am going to be looking at my screen a lot because a lot's going on. If you're looking at the geopolitical risk trade right now, focus on dollar and yields. Yields going lower, risk off. Dollar going higher, risk off, right? Flight to the dollar and vice versa. We had like an intraday reversal, but right now there was actually a pretty decent order, a decent bid going in there for treasuries. You're seeing the equity markets kind of sell off. I would be very cautious around the gold trade, or not gold, the oil trade for right now. But this is a formidable bounce in the near term. And then the last thing I will say is, see where it was trading before, 67-ish, 67 and some change is where we kind of hit overnight. Now we're sitting at around 70, 57. So, in the back of your mind, say 250 in risk premium, $3 in risk premium for this event. If this event starts to kind of calm down a little bit, then that's where you would see that dollar pressure to the downside for crude. So that's what I'm looking at as far as that area. I'll kick it back as I'm about to sneeze here.
And then Kevin, so another thing to kind of talk through real fast, which is the shipping. Oh, Kevin say he had to
I'm
go.
here. Yeah, I'm here. I'm good.
Okay. Kevin, the other thing I wanted to talk to you about is the shipping area. So we basically saw a shipping strike last night. So what are you seeing there, Kevin? Have you gotten a chance to really look into that yet?
Yeah, so here's the thing. It's going to impact pretty much everything besides grains and oil and energy. Let me say energy. So those are going to be two factors that are not going to be put in place, which is why you did not see a bid being put in for energy products right now. So I would suspect if you look at over the last 3 months, 3.5 months of traffic data for pretty much all of these ports, especially if you're looking at the West Coast, which is really not involved in this at all, but West Coast ports, East Coast, we actually saw a significant amount of volume and traffic going into those ports for the last 3 to almost 4 months. I think that this was a scenario that was on the horizon for one thing. I think another thing too, just to be mindful of, is that there's a lot of companies that were trying to get ahead of any type of tariff policy. So I would suspect that you're not going to see an immediate deficit when it comes to supplies in the next couple of days, right? Like this is not going to be a massive event. 3 weeks out from this, you might start seeing some impacts, but this actually could be beneficial. And this is going to sound very weird, but this could actually be very beneficial for certain companies, especially automotive companies, right? So be able to draw down some of those inventories. They also have some strike risk that's happening right now too. So maybe they have a little bit of a leveling out and they can shake it out and kind of blame it on this strike right now. There is a concern about bananas. So take that for what you will. It does seem like there could be an impact when it comes to demand and banana ship. I think it's like 65-70% of the banana traffic goes to the East Coast. So that could be a thing, right? So I'm not too concerned about bananas though. So that could be a thing. But I would say a prolonged strike 4 or 5 weeks out is where you start getting the impacts. I would say a week or 2 weeks, I would not be mindful of this. The perspective is also everything too. And I got to go back to the geopolitical risk and the slack that we've seen in the global economy. Suez Canal, you guys remember that whole situation, right? It was going to be a big event, and it was a big event. Honestly, I mean, there's what 15% of all traffic flow now is going through it. I mean, it's down like 15, down 85%, 90% of traffic flow. We had the Strait of Hormuz, or not Strait of Hormuz, the rerouting around the Cape of Good Hope, right? That actually extended the travel time by around 10 days, almost 2 weeks, if you will, right? Did we see an impact when it came to the shelves? Did we see an impact when it came to inflation? No, because one, demand wasn't as tight as I think the market was actually implying. And I think that's going to be kind of what we are seeing here, where we are saying, okay, hey, let's see, maybe 3 weeks, 4 weeks out, that might be a problem, but I don't think that there's going to be enough there to impact us. Panama Canal, that had a drought, very low levels. We couldn't get shipments to go through, right? What happened with that? So I would say be cautious with it. If there's going to be a player in this space that could benefit, I think it's going to be rail. And so look at those rail, names that are out there in the meantime. But
not much action in the railroads today.
Not yet, but there's a lot going on today, though, too. I mean, let's take the geopolitical risk out of it. We also had ISM manufacturing data set that came in horrible. If you're looking at the top line, new orders, horrible once again. Prices component actually was in the direction of the Fed, so that's really good. Employment from that, horrible. So like there's a lot of, even if we didn't have this scenario here, this has been a week over the last 2 months. This is the week where we see volatility. This is the week where we get the uncertainty because the economic data does not align up with the everything's fine. We have GDP at 3%, consumers really strong. This is the week where you say, oh, okay, manufacturing still sucks. You're going to get ADP numbers tomorrow. That's probably still going to be very weak. You also have the seasonality factor going in next month. And everybody's even already talking about what's going to happen with the labor report. Next month's labor report is going to be god awful. It's going to be god awful because you got way too many things happening. Natural disasters are going to impact unemployment. You have the hurricane scenario impacting this. You have shipping, which will have a small and trickling effect when it comes to unemployment. So the labor market data is probably not going to blow you as great. This is probably going to be the best, cleanest report that we're going to get. And unfortunately, I don't think that's going to be great. So this is usually the week where we see vol. So yeah, I think when you're looking at rail right now, they're not catching a bid. They might not even catch a bid once again for another 2 weeks, 3 weeks. So we actually have to leverage them a little bit. And I think those that have actually rail exposure, especially on the West Coast, going from Canada coming down, is probably going to be the main beneficiaries of this in the near term. So that's kind of what I got. Interested to hear anybody else's commentary around this whole event, though.
I mean, Kashop would probably be the one to talk to you a little bit more about this, but my own small take, and you guys are this is more your area than mine. My own small take is I wonder how weak the shipping industry actually is. Like, how behind are they? Because I think of 2020, and I know 2020 was a massive shutdown. I'm not saying it's the same exact thing. I'm just saying, is it possible that a week or two could actually be extremely disruptive? More than what we're thinking, because to me, I agree with you logically. Like it's perfect. It makes a lot of sense that it's not that big of a deal right now. But if I look at it another way, is it possible that this would absolutely disrupt the economy a little bit more than we're thinking? Kashop, what are you thinking about that?
Yeah, so I think Jason, you're on the right track. And that's just because of the way the industry works. So if you look at retail, the big holiday season's coming up in December. So what usually happens is by Q3 or early part of Q4, most of them get their inventory shipped into the US and it makes their way to the stores. So this comes at a very critical time for the holiday sector. So think you have a strike and you have this issue of something that was supposed to come in October comes sometime in November, and then it doesn't make it to the stores in time, and then you get stuck with inventory that you have to carry forward to the next year because seasonal sales, you don't make it in the season, and then it just gets pushed forward. So what happens is retailers get stuck with a bunch of inventory they don't need, which comes in too late. stores are running empty and they don't have what they need to fulfill orders, and so they fulfill the demand. So what happens is retail sales goes down. Now, when retail sales go down, you will have all these Mastercard Pulse, Visa Pulse, all these players coming out and saying the US consumer is weak. Now that data that gets fed and that gets fed, and it's like the Chinese whisper. So you have a problem with shipping, and then suddenly it gets blown way out of proportion, and it's considered a problem with the economy. So you could get into a situation like that. That's a possibility. And the other possibility is the strike probably just lasts a week or two, and then the ships get routed to the west coast, or they do some form of uh, they manage the inventory in some other way, and then it doesn't become a problem anymore. So the shipping crisis, the shipping sector per se, it's very volatile. So you have the seasonality in the shipping rates, you have the seasonality in the demand, and the players who operate in the industry know exactly when to maximize the value of their ship. So they know exactly when to put it out on a long-term charter, which is anytime from 3 weeks to 3 years. They know exactly when to put their ship on the spot market for hire. So you have a higher demand, and at that time they're going to just charge a higher rate. But hey, you have the ship ready for you, so to take your cargo. So and then you have the whole issue of expediting orders, and then some retailers, some part of the cargo they just send it by plane because it's higher value. They can just do that. So Zara, for instance, is famous for doing that. So you have all these dynamics at play, and you'll never know how exactly it goes until you see the data coming. So that's one part of shipping. And Kevin touched on the whole banana thing, which is very interesting because, um, like bananas, oranges are another commodity which comes from South America, and most of it goes to the East Coast. So you have these huge processing plants which are in Florida, New York, but mostly along the East Coast. So you get this frozen orange juice and the concentrate. They go and they get reconstituted. So that's how the orange juice comes into the market from South America. So if you have delays here, now that's a segment that could be impacted. And while he was just talking about bananas, I was looking at the orange juice futures, and the chart looks great actually. So I think with that, I'll just push it over to Jason to talk about orange juice, because I'm
Yeah, we're
sure there's
seeing
no
orange
one
juice.
who knows more about orange juice than Jason.
Yeah, 3%.
Go ahead, Sam. Talk about orange juice because I know you covered this recently too.
Yeah, no, I love the orange juice. The softs just in general have been working, but orange juice in particular has been strong. Like we're seeing quite the divergence between the softs today. Like you've got coffee and cocoa down big. Like cocoa's down over 7% today, but then you have orange juice up almost 3% today. Still flirting with new all-time highs. It's gone parabolic, kind of like a cocoa chart, but the uptrend still seems to be intact for sure.
Yeah, I
also
mean,
wanted to ask you guys what you think about ethanol leading the energy complex higher today. Does that mean anything to you? From a
yeah,
take-home-
Kevin, why don't you share on that? If you have to go pretty soon, Kevin, why don't you share on ethanol, orange juice, any of the ags you want to cover before you have to go?
So the orange juice trade, I mean, there probably will be a shipping item regarding that right now. I think for the ags, for me, I would say more focused on that China trade. I think that's kind of the big thing. And then for ethanol, I don't really have a comment. I mean, you're looking at something that is still a component of the energy complex there too, right? So I think everything's really just kind of catching a bid. You can even, I mean, corn's catching a bid right now, and that's another major player in that trade. But I wouldn't base my whole trade on corn and ethanol. I would say like we're coming into harvesting season right now. We're probably like 20, maybe 25% done. I would have to look what the updated report was. It was 20% last week when you're looking at corn. And I think it was like 18% when you're looking at soybeans. There's a concern that bean size for soybeans is actually going to be smaller than what they expected, and then there's uncertainty that's happening right now when it comes to the South American planting season right now. So that's really why they're catching a bid. And I think once again they're kind of oversold, but you do have some headline risk some pressure risk or hedge risk when it comes to producers that are still utilizing those contracts to hedge. So they'll short the futures contracts in order to lock in prices. But the removal of those hedges can be where you get that short squeeze to the upside. So that's kind of where I'm at when it comes to the ag plays right now.
And Kevin, I wanted to run this chart by you. This is one we used at the conference for All-Star Charts the other week. And for me, this is kind of just kind of putting out there what we're kind of seeing and how this market usually moves. And we usually see some crazy event that usually makes oil go in a different direction. Do you think that the events and the geopolitical risk could also put in a bottom for oil? Or do you think that oil could possibly go even lower here after the geopolitical risk is kind of out of the way?
I think that you are. We're in a market right now. I'm sorry, I just popped off a trade and that bad boy just hit. So,
Nice.
sorry about that. Let me get out of this thing. Yes. So I would say the oil trade definitely. There's pressure that's there, but there's also a significant amount of short interest in those contracts too. So I feel like the short squeeze aspect of that trade is probably what's going to fuel the rally to the upside. And then also just kind of be mindful too, we're coming in a seasonally weak period in the market traditionally. So that is something that can be a little bit of a headwind when it comes to the oil trade. But I mean, right now it continues to rip higher. I mean, it's trading at $71. You're going to need to have a little bit more though, in my opinion. I mean, if you do have OPEC, is that meeting tomorrow? I think the meeting's tomorrow, right? I think there is an OPEC meeting tomorrow,
isn't it?
Yeah, so the October 2nd. Yeah, so they'll have an OPEC meeting tomorrow. Let's see if they're going to make that determination on bringing more production online starting in December. If that's going to be the case, that's bearish. It's probably already being priced in right now. I think you're going to need to have a sustainable geopolitical event to at least kickstart this, or you're going to need to have China data really come in very strong over the next couple of weeks. I don't think that that's going to be the case. There is a China story that's out there, but it has not permeated within the oil trade at all at this point. So I think I would be a little bit more cautiously optimistic, and I think you're going to get the tailwind of that trade, in my opinion, is still going to be heating oil, and that thing has been a failure. But I feel like the contract that is most oversold and the one that has the seasonality tailwinds for it, I think should be the one that's going to be your major indicator that something's going to go down. Nice. I do have to jump though, guys. I do apologize. I'll try to jump in here and right when I'm done. So I should be
okay. Yeah, no worries, Kevin. Thanks for.
Okay.
We always appreciate you being able to jump on. Go ahead. We'll see you soon, man.
Banana in the tailpipe, Beverly Hills Cop. I love it.
Yeah, I love Nick. He's a good dude. So go and get into the next one. So Sam brought this chart, and so I wanted to bring this up. Sam sent me a bunch of charts, and this is the one that really stood out to me, which is really interesting. So natural gas. What are we thinking here? So Sam, first off, what are you seeing on this chart, and where do you think natural gas could end up?
Yeah, no, I've been a natural gas bull here for the last several months, and we're now in one of the strongest seasonal periods for natural gas. So there's just a lot of tailwinds for it at the moment. But really, you showed that chart earlier of futures ripping after the Ukraine crisis, and natural gas definitely benefited from that. It had a huge run up, but it peaked shortly after and suffered a pretty nasty multi-year drawdown. Since then, it's had several years to build out a base. I don't have it here, but the monthly MACD on natural gas futures has crossed to the upside. So just adding to the tailwinds for it. But really this VWAP anchored to that 2022 peak is my line in the sand. So about $3, which we're just about a dime short of today. But natural gas looks very, very interesting. Like you've got crude oil and heating oil and RBOB testing multi-year levels of polarity. So if you want to avoid that trade, I think natural gas offers a really unique opportunity right now with asymmetric risk reward, might I add.
Yeah, when you look at this chart, the thing that stands out to me is the volume zones.
Yeah,
and this is important.
Here, Jason.
Yes. You had another chart the other day of a gold miner showing basically a volume pocket, so you can kind of see that. But what we're seeing here is it's over the highest volume zone. Which, if you look at the right hand of this chart, you'll see that the highest volume zones is sticking out the furthest. We kind of gapped over that zone, and then there's not much volume or open interest going forward.
Right.
Basically until we hit about $6. So that's a huge move that could be priced in there, and it could happen very quickly. So this is kind of what you're pointing to here, and getting over this VWAP, which is the blue line, could absolutely lead to more upside. So I really like this chart. So Kashop, talking about natural gas, some of the equities in natural gas. What are you seeing in the natural gas market right now?
The equities, they kind of tend to diverge from the actual price of natural gas, and right now they're also being impacted by other factors. So you had the news come out yesterday that the Chesapeake and Southwestern Energy merger that's been approved. So you have consolidation in the space, and then EQT, which is the biggest natural gas producer, just came out and said the production cuts they announced earlier, they are done with it, and they're going to go back to producing. And so you have so what happens with the producers is they kind of if you correlate them over a long period, of course they do tend to move along with the price of gas, but in shorter periods they tend to diverge. So you had this. Let me just pull it up. So Antero Resources, it's not impacted by anything that's happening in this market right now. So let me just pull up the chart. So you had a huge move in Antero starting from February all the way to June. And that was completely disconnected from the move in gas. So we can only speculate as to why the equities move a certain way when the commodity moves a certain way. But uh, oil, the E&Ps kind of tend to move along the same lines as oil itself. But with natural gas, that's just not true. With copper, that's true. With gold miners, it's true. With almost every other commodity producer I have studied, that pattern works. But when it comes to natural gas, the producers just move in their own way. And that's also because they have a mix of natural gas liquids, and oil itself. So the production is natural gas weighted, but it's not exactly 100% gas. And then you have the different hedge books that they run, the different hedging policies they adopt. So and of course, it's a very small market. So compared to oil itself, it's a tiny, tiny market. So tends to move in its own way. And right now, I wouldn't be looking to buy the natural gas producers because I just don't see I mean, it's a long-term value, sure, but right now, I think the trade is, for me, the trade on the energy side would be to stick to oil. And so the reason for that is if you look at what's happened with the oil sector, so there have been three big crashes in the oil market in recent memory. First is 2008, the GFC, which is very straightforward. You had this huge surge in demand because the economy was booming, China was booming, emerging markets were booming, and then you had the big bust, the subprime bust, and the global financial crisis. So demand fell off a cliff and oil slumped. The second one was 2014, and this was the American shale revolution. So you had Saudi Arabia and the US in a bidding war. They both wanted to be the number one oil producer, and they both just overproduced like anything. The US shale producers overproduced because they needed the cash flow to meet their debt, and Saudi Arabia overproduced because they didn't want to lose market share. So that was the period, second half of 2014, $140 to $40. It was a pretty sharp crash. And the third one was COVID. You got negative oil prices because there just wasn't enough space to store the physical barrels at the delivery hub. So you had these three big crashes, and two of them were demand led. The 2014 one, that was supply led. So now, looking at the oil chart, it looks pretty bearish. Like, forget about today's bounce, just look at the overall daily chart. It looks pretty bearish. Now, a chart like this, if it has to crash, which is what happened the last three times it crashed, you should have something that's either supply driven, meaning you have an all-out production war between Saudi and the US, or Russia or Libya coming online, or something of that sort, which we do not see today, or something demand driven, which is a US decision, which again we do not see today. So, barring any of these, I don't see how oil can go lower from here. And now you add in another factor to this, which is the hedge funds are now net short oil for like the first time in history or something, which is extremely unprecedented, which is something unheard of. And I just don't see how a situation like this can resolve without oil going higher. And now you do the same thing, you look at gasoline.
One
It
sec,
sits you
Sam, grab that heating oil chart for me.
With the COT?
Yeah, Sam had a really good chart that basically illustrates what you're saying. Go ahead, Kashab.
yeah. So you look at gasoline again on the weekly, sits at a very critical level. And heating oil, same thing. Yeah, coming onto your winter season, this is just the time when heating oil has to result to the upside. So you have all these factors coming into play. And of course, the Middle East situation, the evergreen fear of Iran's retaliation, all the Ukrainian strikes against the Russian oil refineries, and the Israeli strikes on the Yemen oil depots. So you have all these factors. Plus, let's not forget the shipping side. Kevin talked about this, about how we haven't really seen much of an impact on shipping from all these disruptions. But there has been one factor that has been heavily impacted, and that is fuel demand. So the ships are consuming way more fuel and spending way more days on the water to go around the Cape than going through the Red Sea, through the Suez Canal. So this is adding to fuel demand as well. And this demand has now been on a trajectory higher. So the Houthi attacks on Red Sea shipping started last October. So now it has been an entire year of higher fuel demand for the shipping sector. So you have all these factors that are just telling you, unless there is a imminent demand shock, oil has to go higher. Uh,
No,
leave it to you to explain the futures.
yeah, so I literally I love that because it's exactly what I'm seeing too. I have no reason to think that oil could go much lower here at all. I still think that the big idea that I continue to stick on is the fact that the Fed is cutting rates, that it's a very bad time for them to start cutting rates. That the Fed is always behind the curve, so they're going to do dumb things most of the time, and we just have to be used to that. And once again, it's going to create more inflation in the commodities. And then when you look at this chart, and Sam made this chart the other day. I actually shared it on my channel because it's perfect. I couldn't have made a chart that looks any better than this. And we're looking at commercials, which is the green, and you're looking at speculators. Commercials are net long, and this very rarely happens in heating oil, gold even. Most of the time we don't see the commercials net long because most of the time the commercials are usually hedging their own products.
But look at when it happens, Jason. It
Yes.
happens when it's cheap, when it's
Yes.
near support, before big uptrends.
They love to use the charts. I swear to God, they look at the charts and they look at levels, and because really everybody does. Like whether you're a trader who just trades, you say you're fundamental completely. Every fundamental trader I've ever seen usually looks at a chart when they enter a position. It's everybody looks at it in some way, and so because you have to understand what's cheap, what's rich, and so on. And like you said, Sam, we're seeing that this usually happens at certain points where they think it's cheap. They think that it's a good time to start buying. And this usually puts in bottoms. So, this all kind of is saying like, hey, there's most likely more upside than downside in this space. The one thing I would warn people against, though, is that here you're still buying a bottom. You're not buying an uptrend. You're not buying something that's breaking out. You're still buying a bottom in the commodity space. It is dangerous to do that. But at the same time, I would continue to look for buy signals. Wait for this thing to break a downtrend line. Wait for this thing to make a 50-day high. However you do it, try to wait for some momentum behind it. But I really do think, just with both of you guys, that these signals are amazing. The trend changes are going to happen quickly. and a lot of people are gonna probably get on board late, and that's the way of the market. You know, most people will say there is no inflation, until oil's $100 a barrel. That's probably what's going to happen again.
So, Kashop, if oil's not breaking down here, which equities are we looking to buy? It sounds like you favor the equities over the futures.
Uh, so I have the December WTI futures, but other than that, I have a basket of equities. I'm just going to go over my list and just tell you the names I like. So the refiners, which is HF Sinclair, I think it's dirt cheap. Then Valero, and then Phillips 66, and then Marathon Petroleum. So when it comes to Phillips 66, there is a activist campaign going on with Elliott management trying to kind of get them more focused on the refinery part of the operations. And Elliott, as you know, is an activist investor who has a really good track record. So they think Phillips 66 is worth at least $200 a share, and it's right now at 133. So I think there's good upside there. And in terms of the ENPs, I think if you're into oil, then you have to look at the Namibia place, because just like you had Hess, which was among the pioneers in going to for the name, so somewhere in South Africa, so South America. So just like you had Hess going there, you have this big discovery going on in Namibia. So you can buy Galp, you can buy the smaller names. So you can focus on that. Or if you're just looking for the ENPs, I think your Exxons and pretty much anything listed in US or Canada, uh, and not the Europe. And the reason for not Europe is just because of all the ESG issues. So you had BP and Shell just come out and say, we are done with ESG. We are going to go back to focus on crude. But the American producers never had that problem. So they were always into focusing on oil and promoting that industry. So you even had the Alberta producers go to war with the Canadian government over the insane laws that they put in against the oil industry. So I think any Canadian or US E&P is a safe bet. And right now, it's looking like the offshore drillers are putting in a bottom. Now, again, like if you're buying the offshore drillers, you're catching falling knives. So you're if you're buying something like say Tidewater, you're catching a long consolidation after a long uptrend. So there's no way to tell how long this will take before the March higher starts. You're buying Valaris, you're buying Board Drilling, you're buying any of these names, you're just catching falling knives. But I think this is exactly the time where a value investor would step in and say it is time to start catching falling knives. So if you have your expertise in that area, that's what you would do. And speaking of ENPs, I have my eyes on one of my favorites, which I've been talking about for a long time, is Talos Energy. And the Mexican billionaire Carlos Slim, he is taking a huge stake in the company, and he just keeps buying because it operates in the Gulf of Mexico, and clearly he sees some value there which others are missing. And I think there's definitely something there. And BP just got back to the Gulf of Mexico. So anyone who remembers Deepwater Horizon, they know what a horrible time BP had cleaning that up. And now they are back in the Gulf of Mexico. So I think that's all just telling you that this is the time to be in those GOM plays. And with US elections coming up and with everything that's going on in the Middle East, it's safe to start buying the Canadian producers. And there's another reason for that. Like that's because of the TMX pipeline. So now the Canadian producers can directly ship oil out of the Canadian West Coast. So they don't have to come into the US to ship it out. And that's why if you look at the Cushing Hub inventory, that's hitting a pretty low level. I made a tweet about this the other day. Let me just pull up the exact numbers. But broadly, that's what I would be looking at.
Okay. I'd like to get into gold too, because that's the one that's, you know, it's working, and it's kind of it's the opposite here. And this is why I also agree with you on the idea of like, I'm not a person who buys bottoms. But at the same time, I also agree with you. Like if you were going to do it, now would probably be the time.
The risk is well defined too.
Yes. Yes. So it's a really interesting thing, and part of the story is the gold story, and Sam and I kind of shared on the gold and the commodity cycle at that event as well. And so looking at this gold chart, gold is just ripping. Another great chart from Sam, but we're seeing gold just continue to rip, taking out, breaking out, continuing higher and higher. But the thing I wanted to talk to you about, Kashop, was the juniors and the minors. Like what any of these names make any sense to you? Not saying I know you don't buy the ETFs, but the individual names, because that's your expertise. Like what are the names that are the juniors that you think would possibly move next?
Well, that's a really tough question to answer because uh, if I look at it purely from a valuation point of view, I think a lot of the juniors they are played out,
Mhm.
and that's just in terms of they are priced for a far higher gold price than we have currently. But if I'm talking purely like forget about the angle of the chart, if I'm talking purely from a valuation point of view, then I'm just looking at my list right now and I like I am gold a lot. And
Mhm.
that's just because I think the newest mine that they got online and they are now raised their stake in the mine by buying out their JV partner to a small extent. So I think IM Gold has tremendous value, which is being unappreciated. Then, if you're the kind of person who doesn't mind the geopolitical risk, then there's tremendous value in B2 Gold. But I imagine that's a stock that moves more or less like it's just going to be a trader's dream, wherein you buy it when it's at a low level, you unload it when it's at a high level, and then you just keep playing the game because I think it's going to be stuck in a range, but it's going to be a really good momentum play when it catches the momentum. Then one more is Sibania Stillwater, which is not exactly gold. It's gold and the other precious metals. That is the platinum group complex. And I think that's going to be the same way as Beta Gold. You just play the ranges and you get out. Don't think of it as a long-term holding.
They have some
And
palladium exposure, don't they, as well?
they do. Yeah, they have quite a bit of it. Yeah.
Sam, that one chart, I wanted to run this past Kashop because I know he knows the name. I don't know it off the top of my head. That chart that had the volume pocket.
Yeah, it's
Can you?
SRM.
Yes. Can you bring that up? Because I'm wondering about Kashop's thoughts on this one and the name because it's also the chart looks amazing, but it's also has fallen so far from grace over time that it's kind of interesting. So I
Yeah,
want
it
to
got
pass this
cut in
one to
half in a
Kashop.
single day earlier this year.
Yes. So I think that was the earnings day, right?
No, they announced that there was an accident at one of their mines.
Oh, see, this is why you guys do the equity stuff. Yeah.
Is it First Quantum?
No, it's SSRM, right?
Yeah, it is.
Yeah, SSRM. Yeah.
Yes, okay.
You know the name Kashop,
So
right?
yeah, I know the name. Yeah. So
What are you thinking of it?
the problem with that company is that so they had three or four so mines in different parts of the world, and then they acquired this company called Al Asad Gold, which is based in Turkey. And Turkey is an absolute disaster. Do not go there unless you just want to play the momentum. So they acquired this big mine in Turkey, and the guys who ran the Turkey mine, they took over the board and management of SSR mining. So that's how that happened. So it was kind of like you get acquired, but then you take control. And those guys just ran the company into the ground. The Turkish operation suffered a big accident at its heap leach pad. Like the government got involved, arrested a few of the SSR mining employees, and it's just ugly over there. And if they have, I'm not aware of the other accident they had recently, but if they had one, I mean, mining is a tough business, and when you don't have good operators in charge, things can get ugly really fast. And these guys, they are not good operators.
For sure, and
So
especially if you're not running a diversified portfolio of
yeah,
mines.
no,
Like
so
if you only
they
have
have a
one or two
diversified,
mines and one of your mines gets shut down, like
yeah,
you're in big
yeah.
trouble.
And all of their mines are not the tier one assets. They are all kind of in the second or third quartile of the producing mines. So these are not top class operations at all. So you probably buy these kind of stocks purely for momentum and try to get out, even if the chart looks good, because you never know when an accident will happen. And as someone who's invested in a lot of these gold mines, and I can tell you how much of a knowledge you have, you cannot avoid these accidents. You just have to, like selling options, every once in a while you have to take the hit. So you can buy these stocks, you'll get nice fat gains, and every once in a while you get whacked on the head. Yeah, so certainly looks interesting. If they put their Turkey problems behind them, then probably some upside here. But I really wouldn't hold the stock for too long or put too much of my gold allocation onto this name, mainly because I know the background of the company.
Do you
Yeah.
want to share the next chart, Jason? Like you want to talk about
Yes.
the
Why don't you
CO2
talk through the next chart, Sam?
Yeah, no. So we were talking about the SSRM getting cut in half in a single day earlier this year in February. So that's highlighted on the chart there, and you can see that pretty much no volume was traded at like the 6 to 950 level. So I think if we get above like 590, 585, really $6, if we're above $6, we could get to 950 really, really fast and fill that volume gap. So that's what
So
I'm seeing here. Plus, we're bouncing
I
off
think,
that long-term support level, so it's just a logical setup to me.
yeah. So that move, I think I covered it on Twitter. Let me just find that tweet. It's something fundamentally that went wrong. I don't think that's going to get resolved anytime soon. Let me just find out what happened. I think that was the hit at the Turkish operation.
Sure. And yeah, it seems like the damage has not been repaired yet. We're still on this basing
Yeah,
pattern. So
yeah.
yeah,
And
no
Kashab
buy
said
signal.
people to stay away from Turkey. He was talking to me. He was secretly talking to me about on that one.
No, I
I
think that was a different time. That was 2016, 17 something. You
yeah.
had that huge 100% gain. Turkish equities, Greek equities, whatever you bought at that time, it just worked. It was a wonderful period.
It's a trade. Like you can make these trades, right? You know, that's the thing. Like you can make these trades, but at the same time, it's like understand the risk. It's not something I would trade other people's money in, but personally for myself, like I will take some trades in some things like Turkey once in a while. But I don't buy the individual equities. I always just use the ETF or the futures just because it is the you want to have some diversification because buying the individual equities that would be wild. I mean, Jim Leitner is probably a great example of this. And the only person I've ever heard make a ton of money in Turkish equities, which is there was earthquakes for like an entire year or something. I can't remember what it was. Some natural event was happening. He goes in, he starts to buy window companies, you know, in Turkey, and he ends up making a killing on this. So it's like very few people I've ever heard over the years really walk out with. It's kind of like the widow. What did they used to call the JGB trade?
The Widowmaker.
The
Yeah.
Widowmaker trade. So I always think I'm getting that confused with natural gas, but they did call that the Widowmaker as well,
Yeah.
which it was. So a lot of people got killed in that trade. So it's kind of the same thing in like Turkey. Like you got to really know the instruments you're trading. That doesn't mean that you can't trade them with, you know, I'm not saying you have to understand every fundamental behind it. I'm saying that you have to go back, look at the volatility of the product at the very least, understand like, hey, this thing sometimes gaps 40% overnight, you know, like understand those products and then you can kind of put on those trades.
So
So another one I
the
want to
one
talk to you.
thing,
Go ahead.
yeah. So
Go ahead.
speaking of Turkey or Greek equities or all the other exotic ETFs that you can trade, so I have noticed over the years that those ETFs are no longer on the market.
Oh
So
yeah.
lot of those products they just got shut down. Even a lot of the niche products that you and I used to talk about back in 2018, 19, they're all being shut down or they have like a few million in NAV and no one trades them.
Mhm.
It's just there's been no interest in those markets. So if at all those ETFs come back, I think there's probably a trade there just from the liquidity point of view.
It's wild to think, and Alfonso was talking about this one with you and I, Kashop, a little bit, and he, you know, he covers the international stocks, And it's a home country bias that we have in the United States that just nobody cares. And not to mention the rest of the world also has, oh, we need to buy US equities. So everybody wants to be in US equities, and it's been the right trade for years now. And I get it. But at the same time, it's like exactly what you said. There's so little liquidity in it. Nobody really cares about it. And investment vehicles are driving up to even make the trades. It sounds like a great trade is setting up, and that might sound different to some people who are listening to this. Almost, and it is contrarian in a sense, but it's contrarian in the sense that when you see like an ETF blow up and disappear, most of the time, cocoa, for example, is a great one. A couple years ago, the cocoa ETF disappeared. Finally, people got tired of being chopped up by it all the time. Then cocoa drives up 400% or whatever it did in a couple years. And then basically, if you look at oil, basically when it bottomed was when everybody got rid of all the oil ETFs, especially the leveraged ones. So it's like you'll see that happen a lot of the time. So what you're saying is absolutely right, and I think now is kind of the time to really start looking at these other areas. I continue to talk about because people are talking about China right now, and that's a trade, and I agree with that, and I'm long China as well, but it's other areas also look really good. You can't just look at one area in Asia and go, okay, China's it. There's a lot of areas that look really good out there. So I think people should keep their minds open to getting into these different things because they're not as tech heavy as we are. We're driven, and we've been going up for years because it's been a tech cycle and tech's been dominant. But what if tech isn't dominant for the rest of our lives, which is probably the truth? Like it's probably not going to be dominant the rest of our lives. Then you're going to want to look at different countries. A lot of these countries are heavy in financials, energy, and other sectors. So there is a trade there. I think that's super interesting. But I wanted to hop into this next one with both of you guys, which is uranium. It was a crude chart because it was a trading chart that I used for the group to kind of show an options trade that we were doing. But kind of getting into it, Sam, what are you seeing in the uranium space when you're looking at all these charts? Are you seeing like there's a trade here and breadth is kind of widening out, or does this just look like a false pop?
I think it really depends on your time frame, Jason. Like you didn't show the full context here with the CCJ chart, but really what we have here is a multi-decade basing pattern, and we're still consolidating below the all-time high. And you see that for a lot of these uranium stocks is multi-decade, massive accumulation patterns. So once these are resolved, I think the move is really just to hold on for as long as you can. Like it could be a 10-year uptrend, like a secular uptrend for uranium. But right now, I'm not all that interested, to be honest. Like the CCJ chart looks pretty range bound to me. But that's just my time frame. But if you have a longer time frame, this could be a good time to accumulate before the breakout. It's kind of the way I see it.
And Kashab, what are you seeing in the uranium market? I know you cover it, and real quick, this is what Sam's talking about. So we got this this huge base. It's a reverse cup and handle, really, but this huge basing pattern here that's looking at a breakout. We did get above those old highs for a minute, came right back below it. So we got this false breakout. Really though, if you look at it on a long-term time frame, like this is really, really good. If you're long,
really good. There's not a lot of bases that look like this, Jason. You're absolutely right. Like this is very interesting right now.
I'm glad you brought that up because I haven't really gone back and looked at it full out lately. My model, I mean, you guys can see my buy signal is a 52-week high. For the long-term portfolio, it's been in my personal portfolio for a long time. Kashab's been covering this space for longer than I have. So Kashab, what are you seeing in the uranium space? I know there's been some news lately, some things going on, and people are getting interested again. So what are you seeing in the uranium space?
So uranium broadly started to trade along with the utilities because both of these sectors are being driven by this whole craze around AI. So for training your AI, you need to build data centers. The data centers need power, so you buy the utilities, and then Microsoft goes and says, "I'm going to help restart a reactor on 3 Mile Island." So you have the news coming in that all these so-called green ESG friendly companies are now going nuclear. So that narrative has completely taken over the whole uranium story. So no one cares. So I've been in the space since around 2015, 16. I remember the bottom, and that time the talk was all about how physical uranium pounds were in short supply because US and Russia had an agreement wherein Russia would uh, take down their nuclear arsenal, downblend the weapons grade uranium, convert it into whatever you would need at your power plant, and then ship it to the US. So that was the agreement US and Russia had, and that ended around 2012. And so everyone thought just the fact that those pounds are no longer going to come to market would be good for the uranium producers because they are making the raw material that goes into these reactors. And now the news cycle is completely different. So of course, the industry has done extremely well. There's no doubt about it. But right now, the uranium plays are kind of with the power companies rather than the miners because the narrative isn't as focused on the miners. And even when they are focused on the miners, they are focused on the US building a strategic uranium stockpile, just like they built with the SPR for the oil reserve. So you have that news, or you have let's outright ban Russian uranium. So you have all these news, which is all US centric, which is really benefiting the US producers. So if you look at Cameco, if you look at Uranium Energy Corporation, which is the biggest play in the US, and you ask me to pick one, I would go with UEC, Uranium Energy Corporation, simply because it's US based, and this is an industry where politics is as involved as markets. So UEC is the company that I would go for. And the other reason I would not pick Camco, even though Camco has absolutely fantastic assets in Canada, is because they also have absolutely fantastic assets in Kazakhstan. And if you know Kazakhstan, you know it's a Russian ally. And because the US and Russia are kind of at a Cold War again, and just like what happened with the Russian assets of American companies when the Ukraine Russia war started, you just never know what could happen to Camco's Kazakhstan asset. So one day there could just be a news coming out saying this is happening, and boom, Camco goes down 20-30%. Now, they have already been kind of expropriated by Kazakhstan in that they have had to decrease the share of their joint venture interest in the uranium mines in that country. And the government has hiked the mining taxes and royalties on the uranium there. So now what happens is their joint venture partner is a government owned company, the Kazakhstan government-owned company. So when you hike taxes and royalties on a government-owned company, for the government, it's net it's a zero. For a foreign investor, it's a big deal. So you're already seeing Camco kind of suffering from that. And Camco also has another problem in that they signed a lot of long-term contracts back when uranium was $30, $40. Now it's at $90, $100, and they have to fulfill those contracts. And the problem is they don't produce enough uranium to fulfill those contracts. So they have to buy at $100 and give it to someone at $40. So they lose money on every sale. And this is a fact that investors haven't paid much attention to because it's a bull market and even pigs will fly. But at some point, the uranium price stops going up, the market stabilizes, and then when people pay attention to the earnings, the PE ratio, and consider it just like any other utility stock or any other stock, really, and not just a cyclical stock, at that point, it will matter. And that's why I would rather be in a growth story like UEC or any US producer than in a name like Camco. Even though right now Camco is the largest market cap, everyone would consider it the safest stock, but I would still bet on UEC just because of the different dynamics at play. So when it comes to market, it's not pure fundamentals, it's not pure earnings or anything. It's about the geopolitics, it's about the perception, and I think UEC wins here.
Kishop, what do you think about the more picks and shovels plays like SMR or BWXT? Like BWXT is making all-time highs. Doesn't really look like CCJ.
I'll have to pull up the charts to tell you.
It's a hard thing about this space, which is I'd love to grab a bunch of the small names like that. That's something I would love to do. However, and Kashop knows this more than I do, which is that's how you get killed in this market. Is the small names they're awesome and you can make some money if you get it right, but when you get it wrong, you get it really wrong, and your stops don't matter, your risk management doesn't matter, and that's probably why I stick to such large cap things that I'm always trading, and the reason is because I'm always worried about the downside more than the upside. Because if you worry about the downside, the upside comes, and then you make money on the upside pretty easily. But that downside risk can be really nasty. Someone like Kashop is the only person who could talk to me about a name like that, and I might get interested, but it's really the risk is just so high. So Kashop, what are you thinking about some of those names, the smaller names in the space in general?
Yeah, so you asked specifically about SMR. So they make these small modular reactors, which are supposed to be the future. But then again, this is a very political industry. So if you are going into the sector, I would like right now, especially when I look at the risk reward of buying the uranium miners or buying the utilities or buying something like SMR, I would just say pick the utilities, take the dividend, let the Fed cut rates, your dividend yield on your cost basis is going to go up. You can sleep soundly at night because these guys have the best lobbyists in Washington, and nothing is going to be done to Duke or any of these Dominion or any of these names. They are always going to have political clout. Just sleep well, enjoy the dividends. Why do you need to be in this space right now? Now, there will come a point where these companies sell at a 50 PE, and then you're telling me, do you really want me to continue holding these names? I am up 200% on, let's say you own American Waterworks and you're up 200% on that. Is there really more upside there? No. That's when you rotate. But right now, I would say just stick with the utilities, enjoy the dividend increases that you will get when the Fed cuts rates.
This is how I can tell Kashop and I are getting old. Is then Kashop just mentions buying utility stocks.
Just collect your dividend.
Yeah. Well, I remember in what was it? That was 2019. Like it was the most dumbest trade. Like everybody hated this trade. I was like, let's buy utility stocks, and it was like consumer staples. It was so boring, and everybody hated that trade. But it worked out well. But it's like Kashop's absolutely right. Like sometimes it's a perfect time to buy things like utility stocks and just sit in it and walk away, because it's like you will make a lot of money if this is the right part of the cycle. And I think that's something that we have to continue to kind of be vigilant about. Is it really the right part of the cycle? I'm not sure. And even like, we continue to kind of go back to these charts of this massive, basically looking at 1970s compared to today. The red line is the cycle we're in today. The blue line is from the 70s. And I guess my biggest thought here is that, we're closer to inflation moving higher than inflation moving lower. Like, I really don't think inflation is moving much lower. But in the meantime, it's not a bad idea to own some things like utilities and so on, to make some money if you are bullish on that type of space. But I think all of us are kind of saying the same thing, which is we're seeing the latter part of the cycle move into a new uptrend in inflation. And as inflation starts to move higher, we're going to see assets like oil, energy, even uranium miners might do a lot better than utility stocks at that point. But for right now, we're kind of in that no man's land. I think if we're really looking at it, and I'm really to take my best guess, I'd say by year end, we will probably see oil start to top over $80, and maybe over 90. And that's when it's going to start to really make a move. But once again, guys, just wanted to thank you guys all for coming in. Thanks everybody for watching. And so anybody have any last words, Kashop or Sam?
I think we
Hold on
covered.
to your gold.
Hold on to your gold. Yeah. So Sam just wrote some good stuff for the Gold Rush report. And, like we have a lot of stuff on gold constantly. So I'm really, really excited about these charts. Really excited to talk to both of you guys today about gold, uranium, oil. So thank you guys for coming on, and make sure you guys follow Sam and Kashop, and we'll see you soon.